And welcome once again to Living in the 21st Century. Joining me today is Robert Nichols of Boston Trust Realty Group. Robert, it's always a pleasure to have you on.
Thank you, Errol. Appreciate the opportunity.
Great. Yeah, so today we have some basic questions and educating the public as to what real estate is all about, when to buy, when not to buy, when to sell, when not to sell, etc. But first I want to look at foreclosures, because I think when there are a lot of foreclosures on the market, that pose a threat for the pricing on homes to go down. And then people are wondering, should I sell now and wait until the prices elevate back up? Or what happened to this atmosphere? What really brings about so much foreclosures?
So the biggest thing with foreclosures, Errol, usually is when there's a downturn in the economy, you'll see a spike in foreclosures. But this time around, it's very different. Because of COVID, there was a long-term moratorium on foreclosures throughout the country. And as a result of that, there are a lot of what we call shadow inventory when it comes to foreclosures that kind of been in default for years, literally 2-3 years in some cases, up to 4 or 5 years in more extreme cases, where these folks haven't paid a mortgage in that time frame. They've been in the foreclosure process, and for one reason or another, they have not been foreclosed on yet. And primarily with COVID, with the federal government putting a moratorium on these foreclosures, there was definitely a long time frame where we had a shortage of foreclosures in the market. As a result of that, what we're seeing now is a change and a shift where that time is up. You know, the clock's kind of ticking, and the banks are getting more aggressive now in this environment where, you know, they are now accelerating the process to really push these properties out into the marketplace and look to get them sold as quickly as possible. However, in years past, when you saw that type of thing happen, it really would put a lot of downward pressure on values, right, overall. But the issue with this economy is when interest rates spiked, that caused the inventory to drop, because a lot of folks who are locked in at, let's say, 2% and 3%, 30-year fixed mortgages on the residential side, they don't want to sell, because if they sell now, they'll be looking at getting a 7 or 8% mortgage rate. And, you know, now it's, you know, obviously that's a lot more expensive cost of them buying a home. And so you might have we're seeing a spike and an increase in foreclosure activity. However, values haven't really come down much because we just have a historically low inventory in the real estate market nationally, unlike we've ever seen.
Okay, great. So for the normal person who wants to buy a house and recognize that there's a lot of foreclosures, somewhat the prices may be more favorable in acquiring those homes if they got good credit. And then there's a person who wants to sell their home for the max that they possibly can. What predicament does it put that person in? Having an opportunity to sell their homes at a good price, opposed for the person who are looking to buy one, look more on the foreclosure aspect of things.
So the big thing when it comes to sellers and buyers and really bridging the gap between the two right now to ensure that both sides are getting the best deal possible, I'll jump to the seller side. A lot of sellers right now are all, you know, depending on what you have, if you have like a brand new home and it's, you know, the best in the neighborhood, you know, recently built or recently renovated, you're going to get record pricing still. We're still seeing upward pressure on pricing because there's low inventory. However, buyers are very picky right now. And so if you have a house that is your standard home in this market, the greater Boston market, or maybe even subpar, needs a little bit of work, buyers are not really as attracted to it because rates are higher. So if people are going to buy these homes, they want to buy something that's turnkey and something that fits, because again, it's a little bit of an affordability crisis. People are struggling to afford these homes. And so what's happening is you are seeing homes that sit on the market for a while, whether they're foreclosure, short sale, or even a home that just needs some work, and, you know, any type of distressed property, a home that needs work, where buyers are lowballing and they're getting better deals. I mean, it really comes down to sellers being realistic on pricing, but I would recommend buyers be very diligent about watching the market, being very patient, and really starting to cherry pick houses that have been out there for quite a while or homes that come on that may be distressed like foreclosures, and really just putting their best foot forward, because, you know, that's really what it's going to take to make sure you can afford an affordable home these days. And then the other side to that is the financing side, right? So it's not just targeting foreclosures. It's not just making lowball offers, but additionally, it's looking at what financing is available to you to offset a higher down payment or offset getting a lower interest rate, right? And so there's programs such as NACA, the One Mortgage, and some of these other federally and state subsidized programs through mass housing that allow home buyers to get up to $50,000 down for the down payment, you know, for first time home buyers. So, and a reduced interest rate. So there's quite a few programs like that. And they also have one that leverages a soft second where you don't have to pay on the second mortgage for a certain amount of time. Some of it turns into a grant. So it really comes down to doing the research on the mass housing website, because they're going to have all of those resources out there for these first time home buyers, and then take it to the local level. If you're in Boston, look for the, you know, Boston Home Buying Center. Or if you're in a city like Malden or Cambridge or Somerville, they all have their local offices for housing that will kind of direct you to the best resources to really make the home buying experience affordable.
Great. One other question I'll ask you here. Now, is it wise for a person who are looking to sell their home, opposed to selling it as is in condition, decide well there's some cosmetic fixes and some minor or major upgrading they need to do? Does that really essentially elevates the price when within that environment or community may have a plateau of how high a house within a certain square footage may be able to sell at? You may put in probably $50,000 or $70,000 in upgrades, whatever the case may be, but when you go to sell your home, you recognize it doesn't really make a difference, because if you're going to get $470,000 for your house and you already put in $70,000 in upgrading it, you still probably owe the mortgage company money on it. I think you lose out probably by $70,000. So should a person sell the house and try to acquire the max for that house, opposed to be putting funding into it for upgrades? What is your look at that?
So, Raul, that's a great question, man. I'll tell you, it really comes down to case by case. There are plenty of scenarios where it makes a lot of sense to spend the 30, 40, 50K, and maybe that will net you an extra 50,000 on the end. So you get 100,000 for an investment of 50, you double your money in that case. There are other instances where you might put in 50 and then, you know, maybe you're getting 10 out or 20 out, but there's a lot of time and energy that has to be expended on the project, and it may not be worth it. In this region, one thing I will say is, you know, because a lot of the housing is older, you know, a lot of homes were built in the late 1800s and early 1900s. Depending on the situation, in most cases, you will get the return on putting that investment into the property. However, to really understand those numbers and understand the dynamics as to whether or not you should do it, you definitely want to talk to a local real estate agent who knows that market, who's a top producer in the market, and who knows how to sell your type of property. So if you have a single family home, you know, versus a multi, you want to work with the top single family realtor in the area or in the region, and they'll be able to kind of walk through and give you a sense as to what upgrades you need to do to maximize your profits versus what you can wait on. Or they may say, nope, it's best to sell it as is. This house is good enough. Let the next guy or girl come in and customize it accordingly. But it really comes down to understanding the local expertise. To kind of take that a step further, all the best real estate developers and flippers, you know, they definitely leverage the opinions of the realtors when it comes to picking their finishes, when it comes to the layouts, when it comes to features in the home. And that's really how most savvy investors make decisions. Yes, they have designers and they have a team that helps them with the execution of the finishes, but their realtor is definitely an integral part of the team and a part of the process that ensures that the home fits the needs of the local market and local economy, one, and most importantly, that you're going to make the investments in the property that are going to yield the highest returns for you as the seller or as the investor.
Great. Now, enough of that basic information. I want to go a little bit more advanced. So right now, is the market a buyer's market, a seller's market? What do the market look like for next year here in Massachusetts?
So I'll tell you, Raw, yep, go ahead.
Is it on the upward bound or?
So, you know,
spiral?
I'll tell you, great question as well. I think the big thing right now is there is a ton of downward pressure on pricing because of the higher rates. Nationally, we have seen prices come down. Condos in this region have come down. Single families have gone up. Multifamilies have come down. And I kind of just break it out that way in these different segments because the market currently is very, very segmented, unlike we've ever seen before. Like regionally is segmented. And then asset class wise, it's segmented. Commercial real estate is going through a crash right now. A lot of people don't realize that, but there was a deal recently that traded in Boston where the previous developer, I believe they bought it for 15 million. And, you know, someone was able to come in and scoop it up for 11 million, you know, 8 years later, you know, so, you know, that just kind of gives you an idea that the market is actually extremely segmented right now, depending on where things are going. And so to kind of bring it back to each part of the market, if you're someone looking to purchase a single family, you know, it really depends. In some cases, it becomes a buyer's market if you're dealing with a property that's less desirable, that needs work, needs updates. Now, if you're dealing with a property or all that's been totally renovated or new construction, in some cases, it's a seller's market because there isn't that much inventory out there for those types of properties if you're in the right pocket of the market. And then on the multifamily side, it is definitely a buyer's market. Multifamily and commercial, this is the ultimate buyer's market right now. What's kind of slowing things down a bit is that sellers are not being reasonable yet with price, right? I think it's going to take probably another 6 months or so where you start to see some true softening in pricing for the multifamily market, where it's going to, you know, become a stronger buyer's market. And the same goes for condominium sales. There's definitely a little bit more inventory for condos. You are seeing a lot of downward pressures on pricing. So buyers, they have the upper hand for the condo segment of the market. So I'd say for the most part, it's really going to be a buyer's market in 2024. So kind of sharpen your pencils, get ready, run your numbers, get ready to write your offers, talk to your bankers, and get ready to get some good deals. But on the single family, that's the one asset class in this region. There's just not enough of them. It's still going to be a seller's market.
Beautiful. Now, let's say a person like myself who didn't really have too much time to focus on the real estate market, but over the years we've come to acknowledge the fact that there's always provision there of making money. There's ways that you can buy a house and flip a house and do this type of things. Let's say we want to do that. What would be your advice to me? Should I get with an organization like yours to give me the pointers? Now, I may not have the time to actually go and fix up a house or none of that stuff. But how would you lecture me to start that initial investment of acquiring a house to flip it and get it on the market and make some money? Do I have a company like yours do it, or do I invest? I don't know how to do that. So you tell me how to do that.
Yes, no. So Errol, you like so many other people out there want to get into real estate and kind of don't know where to start. You know, you own a primary residence. Mm-hmm. You may have some equity you want to tap into, and you want to get a good return on that money by leveraging real estate. And so there are definitely many vehicles that beginning investors can use to kind of get exposure and start getting a good return on their money. And I'd say, you know, I recently jumped into the hard money space. I am a hard money lender, and we provide capital for fix and flips, new construction, bridge loans, and even multifamilies. You know, our loans are usually a 12-month term, higher interest rate, but at the same time, it's a short-term venture. And we really become your partner in the project for that length of time. And a lot of folks are investing in hard money funds like the one I'm involved with, and they're able to earn anywhere from a 10 to 11% return on their money paid out, you know, monthly or quarterly. So it's an annual return of 10 or 11%, but you get those disbursements every month to really grow your wealth and build on, you know, what your money is. And it's all backed by real estate. So that's definitely one avenue a lot of folks jump into. Another avenue people jump into are all the syndication. And so you actually are investing in deals with someone like myself. You know, we'll bring an opportunity to you and your network and say, hey, we're going to be doing, for example, a new construction project in Quincy. We're going to be building 2 townhomes. We're looking to raise $200,000 for the project. It'll go directly into the project, and you're going to get a return within 12 months of, let's say, 15% or 17% on your money. But most importantly, you are going to get a front row seat to the process. You have full access to the project, full access to the numbers, and you're able to really learn how to invest in real estate from an experienced investor. And then the next step, I would say, would be mentorship. And so one of the things that my team and I have is a mentorship program now where you can actually jump in with us, get some training, get some learning and development, and then we will partner with you on your first project in order to kind of hold your hand through the process and take you from where you are now all the way to the finish line on the project. Again, that's specifically for fix and flip because it is high risk because there's just so many layers to the process. And then in addition to that, you really want to have a strong team with you of subcontractors, attorneys, accountants, and everything else that you're going to need to really start the project, manage the project, finance it, and really get it done for a profit with a try, test, and improvement process. And so those are kind of the three vehicles that we have for folks who want to kind of get into the investment side and then flipping and have the support, because that's really the key to success. And I've helped many folks over the years kind of start, and they're now, some of them done 10 flips, 20 flips. One guy owns over 50 units. And it all started with that kind of mentorship and one-on-one process where we're really able to take folks from where they are and educate them and get them the skills they need to succeed. And so those are really the fundamental pieces. And lastly, I'd say, obviously, your traditional buy and hold model, my team can definitely help you identify opportunities where, based on how much capital you have now, we can help you find buy and hold opportunities to kind of invest your money in multifamilies and earn a return based on the market. That's harder. It takes a little bit more patience because right now the market's in a strange space where sellers typically want too much and rates are high. But as it becomes more affordable, the multifamily buy and hold strategy in this region is also a very viable way to invest as an early investor.
Okay. So the funding that I invest into your company, that is used on a long-term perspective. So for example, let's say invest $100,000 into your organization with a 15% return. Will this 15% be based on how many projects you do, or would it be on just one project? How that work?
So that would be just on one project, Aral. So let's say these are shorter term, right? So this is a new construction project. We're building 2 townhomes, buying the lot for $500,000. We're going to spend another $500,000 renovating or building the property. And then our expectation is to sell it for $1.5 million. And so that's within a 12-month time frame. You would basically get $15,000 plus your $100,000 back at the completion of and sale of the project. So that's the short term. And then there are funds where they syndicate and you can kind of invest in the fund and you get a fixed return relative to how the property performs. But you have a percentage of equity in the deal on those funds as well. We don't do that internally, but I definitely know folks who run and operate syndication that I trust that would be good stewards of your capital. So there's 2 different vehicles. You're great question on the distinction there.
Okay, great. So this is now the IRS question. So let's say put in $100,000, I got back at the end of 12 months, $115,000. Now, do I pay IRS on that $115,000 or do I pay IRS on that $15,000?
You only pay on what you earn. So you are paying on the 15. Your original principal was 100.
Right.
The 15 will be looked at as interest. So that'll be an interest, tax rate on the way the IRS recognizes that. And that'd be it. Yeah. So you'd only be paying on the money you earned.
Okay. So you consistently then roll over that 100, if it leaves you to roll over that $100,000 annually. Suppose I get greedy and say, well, listen, 15,000 is enough per year. And you decide, well, look, and you said this is for short term, right? Turnover.
Short term, correct.
Could you do more than one project in short term turnover opposed to one within that year?
Correct. Yes. So what happens is it's the money returns to you based on a 1-year term or when the project sells.
Oh,
whichever comes first. Yeah.
Okay,
So it could end up being 8 months, and you'll have that 15,000 within 8 months or 6 months. But at the end of the day, it's triggered. The exit is triggered upon the sale or refinance of the asset.
Okay. So therefore, in that case, could you make an assumption that within 12 months, I'm getting a return of 115,000 or 111,000 based on what the agreement is, and say, well, listen, the house is coming up to close 12 months now. While the grass is growing and the horse is starving, could we take that same $100,000 and roll it into another project before the house is sold or before the year is up?
So if the money is locked in the deal, there really is no way to get it out until before the exit. Yeah, before the refinance.
So you can't have an unlocked deal, right?
Yeah, no, man. I wish that'd be nice. Yeah.
Those are questions that I'm asking because and you said it for yourself, there are many folks who are somewhat savvy when it comes to the real estate market, but common sense tells them that it has some lucrative feedback to them when get involved, but they just need to know the ways in going about doing that. And your company offer that kind of service and opportunities to invest in also.
That's correct. Yes.
Right.
And that's something more recent, Aral. Over the years, we were just kind of doing it on our own internally. But now we decided to open it up to our network, friends, family, and folks who really want exposure to the real estate market and may not have the level of experience needed to feel confident that they can go out there and do it on their own.
Right. So in this case, a person can take out a HELOC on their property and invest that money into this kind of a deal that you have that consistent turnover annually.
Oh, yeah, absolutely. They can invest in either a real estate syndication deal or into a hard money lending fund that we're operating and a part of.
So which one do you think is the best, the hard money lending or?
You know, I'll tell you, Aral, I think the lending side, it's a lower return because it is a little bit less risky. It's not as volatile to the market where you're doing a project and there's some speculation, right? Because market conditions change. So within 12 months, you could have a property you was expecting to sell for $2 million and now you're selling it for 1.8, and it definitely changes the dynamic a bit. Whereas with the fund, that money is going to be invested where it's backed by real estate, but the real estate backing it, the collateral, the fund is only exposed by about 70% of the property value. So if a property is worth $1 million, the fund is only going to lend maximum $700,000 on it when it's completed. So there's a 30% margin or cushion, basically a safety net that's always built in the fund. And that's why it's just a lot less risky, and it's just money churning because it's just working every day, for you. So I'd say if you're less risk averse, the investing in the hard money side, investing in a fund would make the most sense. If you're looking for a higher return and you're comfortable with investing in real estate and being in a part of a team environment, then investing in a deal in an actual real estate project would be a good way to go. But it comes down to your risk tolerance and really your financial goals.
I see. Well, we're down to the last couple of minutes of the show already. Is there any advice now you have for the public at large who may want to either get for the first time next year a home as a first buyer or want to invest? What are the pros and cons they should look for?
Yes, Aral. So I'll talk to first-time home buyers first. One thing I've seen and realized is that this is an unprecedented time for resources and financial support for first-time buyers. I've never seen so many programs. You have the Dream Loans program, you have the One Mortgage, you have all of these soft second programs through Mass Housing. Do your research and really take advantage of all of the free money, the grants and loans that are out there exclusively for first-time home buyers, because when you have these types of situations, they don't last forever. So it's really going to be the people who are proactive in 2024 who take advantage of them and really save themselves thousands of dollars and really start building generational wealth. So that's really, I'd say, the number one thing if you are thinking about buying a home in the next 12 months. really do the research and take advantage of all of the local, state, and national programs available to you as a first-time home buyer. For folks who want to get into the investment space, I really encourage you to be patient. Investing in real estate can be very rewarding, but it takes time to find the right deal. And then even after you find the right deal, it can take time to get it stabilized, meaning, fully rented, renovated or touched up to really maximize your return on that property. I know some folks, they can take a couple of years before the property's actually, generating cash flow at the level that they know it can, just because you may have to wait for a tenant to leave. And then you got to do, quick little patch and paint, maybe put in some new appliances, and then you can charge the increased rent. So I really advise folks, just be patient in finding the right deal and be patient with yourself relative to taking the time it requires to really stabilize the property to get a good return and build a solid foundation for your wealth strategy.
Well, on that note, Robert, it was a pleasure having you on. I think it was a very educational moment. And for all those who have been tuning in on Living in the 21st Century, have a nice day.